All right, just testing to see if you guys can hear me, and we'll check with Jessica. All right, can you hear me now? All right. We are operationally a go here, but we will wait another minute, let people check in. Let's see where we're at. All right, people are flowing in here. Oops. All right, it is now 11:30 a.m. I am your host, Dan Romero, and welcome to this year-end equity market update and proactive tax planning presentation. So this is our third presentation of this nature this year. We'll be doing a second one tomorrow. It's basically going to be the same thing. It's geared towards our 401k participants, but if you found this useful, then feel free to pass that on to folks tomorrow, and we'll get that cooking. Now, I do encourage questions. So through the course of this presentation here, if you have any questions, there should be some sort of methodology here where there's a Q&A button. So even if, you know, the topic looks fine, if it's live on your head, go ahead and ask that question, and I'll touch on all those at the end of the presentation if anybody has anything. So with that said, no further ado, we will get things cooking here. That one doesn't work. Let's try this. There we go. So we do these things because, you know, in the world, I know a lot of folks come to us because they just don't want to think about it. But for those of you that like to put the extra effort in, it's certainly an educated client is our best client. So anybody that takes the time and to really understand what's going on, it makes it a lot easier for us to manage the portfolios and do what's best in your interest here. So this is just a little bit about what's going on in the world. So we are going to give you an update of what's going on in the economy right now in the stock market, and then also some proactive tax planning ideas as the year closes out here. So as a reminder, there are 5 key areas in the financial planning process. So that's preservation of wealth, retirement planning, tax planning, estate planning, and investment planning. So we'll touch on a few of these things through the course of the meeting to let you know what's going on here. Our office just goes beyond traditional wealth management. We want to look at your entire situation from a comprehensive method. So that's what this is for. So 2022, let's look at what's going on here. That was really starting to get behind the rearview mirror. It was a pain in the butt, to say the least. Stock market was not cooperative, but not only was the stock market horrific, the bond market was rough as well. So we've moved past that in 2023. But a lot of the concerns that were happening in 2022 still did exist going into this year. There was talk of a recession coming this year. That still is something that we're concerned about. World War III, is that going to happen in 2023? Well, Ukraine's still gone. We got this issue that's going on in Israel right now. Inflation has been an issue. Interest rates have been an issue. Federal government every 3 months is talking about shutting down. So these things that were major concerns coming into this current year still exist today. Now, with that said, the S&P 500 had a nice little rebound here. So you can see the blue line in the middle indicates the end of last year, basically. And you can see it was a straight line down, and basically it's a line up. We've seen a little bit of turbulence over the last month and a half here. So that's definitely something we're keeping an eye on. But for the most part, this has been a nice crackback year for the stock market. So that's good. Now, again, when it comes to retirement planning, we always want to take a long-term approach when it comes to investing. If you're looking to buy a house in the next year or some sort of major purchase, then certainly we want to take a closer look of how you're invested. But if you have an allocation into the stock and bond market, the long-term perspective is what really provides winners in this world. So our concerns right now, going to look very familiar. The direction of inflation, interest rate changes, recession concerns, and then, of course, the continued geopolitical unrest. So those things are at the height of what's going on. So we'll start with inflation. So inflation, you can see the chart here dating back to 2005, you can kind of see where it's at, had been pretty low for a while. And then we had a tremendous spike that came out of COVID and really expanded into 2022. Now we've seen it come down. The Fed has taken some pretty severe measures through interest rate hikes. And we saw in August that rate was about 3.7%. When we exclude food and energy, it's actually closer to 4.3%. So the inflation has definitely pulled back, but it's something out there. And all the high prices that we got to enjoy last year are still here for us. Now, in line with that, the Fed decided we are going to aggressively raise interest rates. And you can see here at the very bottom of this page, on March 17th of 2022, I mean, we're talking about a year and a half ago, rates were at 0.25%. Getting a loan, a mortgage at that time was really nice. All that is out the door. And you can see going all the way through July 26, all these interest rate hikes, the target range is closer to 5.25 and 5.5. They did raise rates one more time, and we're potentially seeing a rate increase coming towards the end of the year as well. And that's it. Right into my next slide. I probably should have looked at it first. But yes, the Fed is possibly thinking about raising rates before the end of the year. So we'll see. They're looking at whatever indicators they're looking at to determine if they're going to raise rates one more time. A lot of it is going to be dependent on where we are with inflation. Their target rate is closer to 2%. I don't know how they're going to get there, but that's kind of what they're looking at. So we've got our eye on it. But we have seen interest rate hikes slow down quite considerably. Did I go backwards here? I did. So looking at the chart, when we bring out the magnifying glass much bigger here, and we go back to the 70s here, you can see where do we rank on an all-time basis as it pertains to rates. So certainly the 70s and 80s were times that were unprecedented as it touched with interest rates and Fed fund rates. But you can still see here, over the long haul, where we're at today isn't really anything outside of the norm. It feels abnormal right now because we've been in such a low interest rate environment going back to 2008. That was one of the financial crash that we had at that point, and they just slammed rates all the way down. And we got pretty low for a while, tried a little bit of an increase going into 2020 with COVID, and then again went back to square one. But historically, we're not necessarily in a bad place. But we'll see. We'll see what continues to happen here. Rising interest rates isn't always a complete loser. It hurts if you want to buy a house, but if you're a retiree, it's been very helpful for us because now we're able to put assets into our portfolio, bonds, fixed income, things like that are paying rates that people can enjoy. So, I mean, you've seen it out there. You can see CDs at 5%. We're seeing Treasury bills, T-bills north of 5.5%. So there's been some pretty good things from that front, and it's really helped when we have that safe side of our portfolios. Now those things can participate and give us an opportunity to make some money. So that is a positive to it. Now the recession concerns are still here. I know we haven't quite hit anything that says we're in a recession yet. There are certain areas of the economy that are definitely in a recession. Anybody involved in the real estate world definitely knows that because it's just not the same. But there are other areas that are still doing pretty good right now. Earnings are starting to come out. We're analyzing that, and so far it looks pretty good. But the recession concerns are still there. A lot of what's happened with interest rates going up is going to be a degree of a lag, and we could see that coming into the end of this year and early next year. So we are still continuing to be cautious on that front. The geopolitical risk just keeps expanding day by day. Ukraine was the big story. There was fear that Taiwan and China was going to engage in some sort of activity. We haven't seen that yet. Hopefully that never happens. But now the latest thing is what's happening with Israel and the Middle East and Palestine. It hasn't seemed to affected the stock market too much at this point yet, but it is stuff that we're looking at here and could lead to some sort of wider global event. Depending if other countries like Iran, Russia, China, and what level of involvement people are at. Right now, it seems to be contained, but we will see. This is not a good situation that we're in. Now, this is it's just, the irony of it all. Greg Toby and I, we meet in our committee meeting and we go over investments and we look at pundits and what's going on, what everybody's saying. And, whatever you want to see or read is out there. But this Business Insider, back in September, on the same day, they put out these two headlines that we found amusing. So on the left, stock market crash, recession will sink the S&P 500 by 40%, economists say. And then on the right, on the same day, why the stock market could rally 25% in 12 months, Bank of America. Again, it goes back to what we've been talking about, for years, is investing is a long-term game. It's really difficult to time the markets. We don't try to time the highs and the lows. We determine what type of risk you're willing to take. We want to ride through that. What we will do is hedge and lean into certain areas that we feel there's opportunity, or where we need to have protection, we will. But it's the world we're in. You can find whatever news you're looking for out there. Now, historically, we are entering the fourth quarter now. Historically, this has tend to be the best period of returns in the stock market. It's not saying we have a crystal ball. We know what this quarter is going to do. But when we look at the past 70 years of the investment world, things have gone pretty good here. So while there is a flurry of news out there, that news has been around for a couple of years and not much has changed. So we'll see. We're continuing to monitor the situation and invest under a long-term perspective. Again, you look back 10 years, 20 years, 40 years, the trend line is very similar. As you move on later in your years, your exposure to the stock market might not want to be as aggressive, might want to have as much in there. So that's something that we want to talk about in case you feel that you might have too much of an exposure into the stock market. But, people are living a long time, and there's going to be a point where to keep up with inflation, we need to have that. Now, the big yellow caution sign that we've thrown up all year, historical results are no indication of future results. We still believe caution should be the principal notion for investors. And so that's what we're looking at here. Not a ton of our clients are super uber aggressive. Most folks are near retirement or in retirement. And so that caution really leads the day for us. So things that you control, the risk tolerance, so when we do go through a period where the market is a little volatile, how does that affect you? If it really turns your stomach sideways when the market is crashing, it's a good reason to reach out to us, and maybe perhaps you're a little bit more aggressive than we need to be, or vice versa. If it doesn't bother you when the market, falls down, then potentially you could be more conservative. So there's things where we want to continue to have our ongoing dialogue that we do with everybody in here. What is your time horizon? How long do you plan on? When do you need the money? So again, if you're looking to buy a house in the next year, we would consider that a very short time horizon. Doesn't make any sense to have money in the stock market. But if we're talking retirement over 10, 20, 30 years, that can have a place. What's your behavior? When the market crashes, you get anxiety. Do you want to pull everything out? Do you make decisions of that nature? So that's something that you can control to a certain degree, and we can help navigate you through it. And what's your overall strategy? What are you looking for? Dividends? You need to total capital appreciation, whatever it may be. So these are the things that we work through with you and can help you with. Warren Buffett, we always try to get a guru in here to lend us a quote. So he was very kind to tell us this. The most important quality for an investor is temperament, not intellect. The people I see that fail are the folks that are reactionary. So when the market is crashing, they want to go to cash. When the market is excelling, let's put more in. So now they've taken on more risk when the market's doing great, and they don't have any risk when the market's down. Well, what happens when the market bounces back up? Or what happens if the market crashes at the top? That's where we really see people compound their mistakes. And so that's where our true job here is to kind of keep you through that, navigate you. So some takeaways. Caution is still the principal notion for investors. Inflation is still something that we are concerned about, and the Fed is certainly monitoring that. Interest rates could continue to rise. We're not expecting anything like 2022, where rates went from 0 to 5.5 to 6%. but it looks like we may see a few more interest rate hikes, particularly one in November, but we don't know for sure. We'll just keep an eye on it. We think recession is still a real possibility, so we'll watch that. And then again, long-term investing is key when it comes to the equity markets. So stick with that. And always remember, we're here to help you. So now on to the tax planning stuff. So we like to take a proactive approach to tax planning instead of a reactive approach. So again, we're not CPAs. We are not tax preparers. You want to always run everything that we may discuss through your tax preparer. We do have some new software that we are working on internally that can help with some planning opportunities. If you'd like to guinea pig that, feel free to reach out to us. There would be no cost, but it's a pretty neat tool that we've been looking at for a little bit and starting to implement internally here. So again, we're not going to prepare your taxes. We're not going to give you advice, but we can give ideas. We can discuss ideas, and ultimately you want to run that through your tax professional. Now, here are things that you need to be aware of. The tax rate brackets for 2023 have remained the same. They are not going to be changing anytime soon. Perhaps with a new election in 2024, we may see some different things. But right now, the rates that you've been enjoying for the past, 6-7 years are going to continue that way going into 2024. So that's great. The standard deductions, there's been a slight increase here. So you can see individuals, $13,850, married couple, $27,700. So again, talk to your CPA to see where you may fall into this here. Itemized deductions. The old rule was you wanted to accelerate deductions to try and get them into this year and get it cooking. The new rules to time or plan your deductions. So it really depends on what your situations, and be careful about how you plan them. So keep that in mind. There could be good opportunity to have them this year, but not necessarily. Long-term capital gains rates, they're not changing. A lot of people may not notice this here, but married filing jointly, you can see the capital gains rate is 0% up to 89,000. 15% from 89,000 to 553. But that 0% is something to consider taking advantage of if for some reason your income is low, if we're out of work for a period of time this year, if your income situation changed drastically. That's an area where you'd want to reach out to us and say, Dan, remember you said something, my income is lower this year. Maybe there's some things we can do where we tax harvest the gains rather than the losses and try to enjoy some of that 0% capital gain. But even still at 15%, that's great. So good news from that standpoint. Speaking of harvesting, I talked a little bit about tax gain harvesting. So if you're in a very, very low tax bracket, then sometimes we'll sell something so you just pay a 0% tax on it if you're in the right space. Tax loss harvesting is normally where we run into this. So at the end of this year, we're going to look across portfolios and try and find positions that we feel potentially we could bank those losses to offset future capital gains. You also can use $3,000 of capital losses to offset ordinary income. That's the best way to use it because ordinary income is higher than a capital gains rate. So through the course of the year, we're always trying to bank those anyways for folks, just so you have them in your back pocket, because we will return, like this year is actually going to be a pretty positive year. But last year we were able to harvest some pretty good stuff. And this year there will be some opportunities. So let's look at your retirement saving strategy. For those of you that are still working and have earned income, these are the rates that you can get in your company retirement plans or individual IRA accounts. So an IRA or a Roth IRA, you can get $6,500 in. If you're over 50, you can get an extra $1,000 in. Your 401k, if you're under 50, you can get up to $22,500. That has to come from your payroll contribution. The catch-up is this additional $7,500. So if you're over 50 years old, you can get as much as $30,000 in your 401k. That can be a combination of a traditional or a Roth 401k. So see me, give me a call, send me an email if you have questions about that. Not a lot of people have exposure to simple IRAs, but that's $15,500, also a $3,500 catch-up. SEP IRAs, 25% match. There could be, if you're, I mean, it says, 25 for self-employed, there may be a little bit of a discount there, but we'll see. And then defined benefits for those of you doing cash balances, pension type contributions, you can get as much as 66,000 and up to 73,500 if you're older than 50. So if you're maybe a small law firm, small doctor's office, those type of plans can be very, very popular. It's a way to get a ton of money in into it and potentially even more. So keep in mind on that for your profit sharing. Now, Roth conversions, we talk about this at every basically every seminar we have, because it's a very popular item to talk about. Now, it doesn't necessarily work for everybody. The problem with these things is it's all going to be taxed as ordinary income when you make that conversion, but it could help you in the long term to lower your taxable income. You're going to get tax-free compounding. There's no RMDs at age 73, and the withdrawals to your beneficiaries can be tax-free. So this is where the tax tool that we're working into the practice can really help clear the picture up for those of you that are thinking about doing Roth conversions. So again, take advantage of this, especially, like I said, we're not going to be charging anything for this software at this time being, so take advantage of what we got it right now. So how do you look at a strategy? If you've got more money than you need and you got to figure out what you're going to do with it. Now, this is just a very simple thought on how to look at a conversion strategy. But if you look at this and the marginal tax rate holder, the person that owns the IRA right now, is in a high tax bracket and the beneficiary is in a low tax bracket, it doesn't make a lot of sense to pay the taxes now and convert. It's better for them to get the IRA and pay the taxes at their rate. But perhaps your beneficiary is pretty successful and they're doing well, they're in a high earning period and you're living off lesser means, and they are in a much higher tax bracket than you, then it could make sense to convert now, pay it at your lower bracket, and then the money will go to them tax-free when it gets to their point. So this is an area to consider when you're trying to determine if it makes sense to convert to a Roth so you can pass money on to your beneficiaries tax-free. College saving plans, another great way to get money growing for you tax-free. In most states, you don't get a tax benefit for it. Some states do afford you that, but the money does grow tax-free. So great way if you have grandkids or children that you want to help save for college. For those of you in the business of giving money away, you can now give up to $17,000 per donee. So a married couple could give one of their children 34 grand. And this means you don't have to use any part of your lifetime exemption. Anything that you give above that, if you don't lose your lifetime exemption, there can be a gift tax rate for that, but it's pretty simple. You would fill out a tax form that permits you to use part of your life exemption. And so what is that right now? Right now, you can give away about $12.06 million per person. And that would be for each spouse. So the husband and the wife, they both can give away 12 million. So 24 million for a family could be given away. That is set to sunset to $6 million in the year 2026. So if you are in a significant estate and you are concerned that everything is going to sunset and your heirs can only give away 6%, $6 million, because maybe you own a business or something along those lines. Those are things that we can talk about over the next couple of years. Anything above that this year, if you weigh more than that, it's going to be, the gift tax will be, estate tax will be 40%. It will go back up to 45%. So this is all set to sunset in the year 2026. This is a fun thing that we've been working on, folks. When you have your IRA, and if you are charitably inclined, you can shift your RMD, your required minimum distribution, directly to the charity. Now, 73 is the new RMD age. However, you can start this at the old RMD age of 70 and a half. So these distributions are still allowed at that place. So if you have your RMD go directly to a qualified charity, then you would not pay taxes on that. It would not be shown as ordinary income on your returns. So this can be a little bit complicated, and we're handling this for a bunch of folks right now. But what you want to do, contact our office and say, look, I'm already giving $5,000 away to this charity. Now, if I can redirect my RMD there, I can avoid the income tax on that money that I don't necessarily need coming out of the IRA. So it's a really smart thing to do. Now, what do we get to look forward to? So if we remain in gridlock, the Tax Cuts and Jobs Act of 2017 is going to sunset. A lot of the provisions are, at least. So what will change? Our individual income tax rates will change. They will go up unless Congress gets together and comes up with something. The elevated estate tax exclusion return to pre-28. We just showed that, where instead of being able to, the 12 million you're able to exclude now drops to 6 million. Something that you might like here in California, that SALT cap will disappear. Child care tax credit will revert to 1,000, and the AMT tax will revert as well. So there's a lot that our government is going to have to work on over the next few years, or we will see things return back to how they were. Now, again, we want to take a proactive tax planning approach. So keep us in mind if you'd like to do that. And we've got, like I said, we've got some new tools here that we're working on. What can you expect from us? Again, we're going to regularly keep in touch with you, want a regular communication. For those of you that haven't seen it, we have a YouTube channel, and I've been getting online and doing a market minute. So every Thursday or Friday, after we wrap up our portfolio meetings, I kind of outline what we're seeing out in the marketplace. So you can go to our YouTube channel and join that. Or if you'd like, we can text out the link. It's just a minute tape of me kind of outlining what's going on. So drop me a text, or you can send me an email, and then we can text you out that little market minute each week. So we're increasing that as well. Always going to be, we're sending our newsletters out and everything. So what we'd love you to do is don't keep us a secret, share us. Our target market, we're looking for folks near retirement or in retirement. Even if you feel someone's not ready to move to our firm yet, maybe they just like to take a look at our newsletter. So we'd love to have your family and friends, beneficiaries, folks that might be taking over your accounts, add them to our mailing list, and they can kind of keep up with what we got going on over here. So please do share. I'm going to leave the disclosures up here so you guys can read this, and I'm going to take a look because we do have a question. Okay. Can your RMD charitable giving be put into a donor advised fund? As far as I'm aware right now, they cannot be put into a donor advised fund. They have to go to directly to an actual charity. So I'll double check that in case something has changed since the last time I looked into it. But as far as I know right now, those cannot go into donor advised funds. Are there any other questions? If you had a question, what would it be? Okay, great. I'm going to wrap things up here. I really want to thank you all. We appreciate the opportunity to assist you. And again, your health and well-being is always our highest priority. So keep doing what you're doing. Stay healthy. Call us with anything. Don't let this market bother you much. Let us get the ulcer for you. No reason for you to get it. But you know where to find us. Call, email, and we do have our new secret Texoso line. So if you happen to have my personal cell phone number, never text me there. Only text me at the business number, which I believe is 714-831-1948. And if you want to text me at 3 in the morning, probably not going to answer you, but I will see you in the morning. But that's all we got. We will see you in the beginning of the new year. Take care, everybody.